Many people believe that saving money is the key to financial security. However, consistently cutting expenses without increasing income can actually limit your long-term wealth. This means you might be missing crucial opportunities to improve your financial future. By the way, this channel shares one thoughtful insight like this every day. If this perspective is useful, consider subscribing. In today's interconnected world, the way risk is managed and redistributed has become a central concern across industries, governments, and individual lives. From financial markets to supply chains, from health systems to climate resilience, modern systems are constantly evolving to shift and share risk in ways that were unimaginable just a few decades ago. This topic matters now more than ever because the scale and complexity of global challenges have increased dramatically, exposing vulnerabilities that traditional risk models can no longer address effectively. Take the example of the insurance industry, which has long been a cornerstone of risk management. Traditional insurance models were designed around relatively stable risks, such as property damage from natural disasters or health issues within defined populations. Now, with climate change accelerating the frequency and severity of extreme weather events, insurers are forced to rethink their strategies. They must incorporate advanced data analytics, real-time monitoring, and even artificial intelligence to predict risks more accurately and price policies accordingly. This shift not only affects premiums, but also influences how capital is allocated across the financial system. Similarly, supply chains have undergone a profound transformation in their approach to risk. The COVID-19 pandemic exposed significant vulnerabilities in global supply networks, where just-in-time inventory systems left little room for disruption. Companies are now investing heavily in diversification and redundancy, such as sourcing from multiple regions or reshoring critical components, to mitigate the risk of future interruptions. This trend has broad economic implications, potentially increasing costs, but enhancing overall resilience against unforeseen shocks. It also challenges the long-held assumption that efficiency should always trump robustness. On an individual level, the concept of risk redistribution is influencing retirement planning and personal finance. Traditional pension models, often funded by employers or governments, are eroding under demographic pressures. As a result, individuals are bearing more responsibility for managing their own retirement risks through diversified investment portfolios, insurance products, and flexible income strategies. This shift requires a deeper understanding of risk tolerance and the potential trade-offs between security and growth, which many people find difficult without proper education or advice. These examples illustrate that risk management is no longer a static or isolated practice. Instead, it is a dynamic, system-wide challenge that demands innovation, collaboration, and adaptability across all sectors. For individuals and organizations alike, recognizing and responding to the evolving nature of risk is crucial for building sustainable financial security and resilience in an unpredictable world. Beyond these sectors, the financial industry itself is grappling with the implications of risk redistribution in the context of systemic threats like cyberattacks and geopolitical instability. Financial institutions are increasingly exposed to risks that do not follow traditional patterns or historical precedents, necessitating new frameworks for stress testing and capital adequacy. For instance, cyber risk has introduced a non-linear element to financial stability, where a single breach can cascade through interconnected networks, amplifying potential losses well beyond initial estimates. This has prompted regulators and firms to adopt more proactive, scenario-based approaches to risk assessment, integrating cybersecurity measures as fundamental components rather than ancillary safeguards. Moreover, advancements in technology are creating novel avenues for risk sharing through decentralized finance, DeFi platforms, and blockchain-based insurance models. These innovations democratize access to risk pooling and capital markets by reducing reliance on centralized intermediaries. For example, peer-to-peer insurance models allow groups of individuals to collectively underwrite potential losses, lowering costs and increasing transparency. However, these emerging mechanisms also introduce new uncertainties related to regulatory oversight, smart contract vulnerabilities, and market liquidity, underscoring the need for continuous monitoring and adaptive governance structures. In the public policy domain, governments are recalibrating their roles in risk redistribution amid increasing fiscal pressures and social expectations. Natural disasters, pandemics, and economic downturns often require large-scale interventions that redistribute risk across taxpayers, insurers, and private entities. The growing frequency and severity of such events challenge traditional social safety nets and demand innovative policy solutions that blend public and private resources. For example, catastrophe bonds enable governments to transfer some disaster risks to capital markets, providing immediate relief funds while incentivizing risk mitigation efforts. These hybrid financial instruments reflect a broader trend toward shared responsibility and multi-sector collaboration in managing societal risks. At the household level, the rising cost of living and volatile labor markets further complicate personal risk management strategies. The gig economy and contract-based work arrangements often lack traditional benefits like health insurance and retirement plans, forcing individuals to seek alternative means to buffer against income shocks. As a result, financial literacy around products such as emergency funds, indexed annuities, and income protection insurance becomes critical. Yet access and comprehension remain uneven, highlighting persistent socioeconomic disparities that risk compounding vulnerability rather than alleviating it. The evolving landscape of risk distribution, therefore, intersects with technology, regulatory frameworks, and social equity considerations, demanding a holistic and forward-looking approach to financial resilience. One important implication of this evolving risk landscape is how credit markets are adapting to new definitions of creditworthiness. Lenders increasingly incorporate non-traditional data points, like utility payments, employment history from gig platforms, or even social media behavior, into their risk models. This shift can expand access to credit for underserved populations, but it also raises concerns about privacy, bias, and the accuracy of predictive algorithms. The balance between innovation and consumer protection is a delicate one that financial institutions and regulators must navigate carefully to avoid unintended consequences. In corporate finance, risk redistribution is influencing capital structure decisions. Firms are reconsidering their debt-to-equity ratios, factoring in not only traditional business risks, but also emerging threats such as regulatory changes related to environmental, social, and governance (ESG) criteria. This trend is prompting companies to issue green bonds or sustainability-linked loans, which tie financing costs to performance on social or environmental metrics. Such instruments realign incentives among investors, managers, and other stakeholders, potentially reducing systemic risk by encouraging more sustainable corporate behavior. The insurance industry's pivot to predictive analytics also has ramifications for social equity. While advanced risk assessment can lead to more accurate pricing and reduce adverse selection, it can inadvertently marginalize high-risk individuals or communities by making insurance prohibitively expensive or unavailable. This raises ethical questions about the role of insurers and policymakers in ensuring equitable access to essential coverage, especially as climate change disproportionately affects vulnerable populations. Meanwhile, at the macroeconomic level, central banks and financial regulators are integrating risk redistribution considerations into monetary policy and financial stability frameworks. Stress tests now often include scenarios involving climate-related shocks, cyber crises, and geopolitical disruptions. These expanded frameworks aim to identify systemic vulnerabilities before they materialize, allowing for preemptive policy responses. However, the complexity of these risks challenges traditional modeling techniques and requires ongoing refinement of analytical tools. Finally, the cultural understanding of risk is also shifting. As individuals and organizations confront more complex and interconnected threats, there is growing recognition that risk cannot be entirely eliminated, but must be managed dynamically. This cultural shift encourages a mindset of resilience and adaptation, promoting continuous learning and flexibility in financial decision-making. However, embedding such a mindset requires education systems, employers, and communities to prioritize risk literacy alongside traditional financial skills. As we navigate the complexities of this issue, it becomes clear that responsibility rests not only with institutions, but with each individual who interacts with the system. The choices we make, whether in consumption, participation, or advocacy, reflect and reinforce broader societal values. Recognizing the trade-offs involved between convenience and privacy, innovation and oversight, short-term gains and long-term stability, demands a deliberate, informed approach.